Good morning, ARMR Insiders. And yes, you're looking at a chart of MicroStrategy. We'll get to that in a minute. Hope you all had a wonderful weekend. We're going to cover risk monitor, big picture. We like to break down our investing strategy into three categories. We day trade the indexes, we swing trade the indexes, and then we have our investments, whether they be the ARMR Invest portfolio or ARMR Special Situations. We kind of manage the capital with those three categories. So we're going to touch on each category. I'll share with you what we were doing last week. Maybe I kind of think of it as a big change to how I want to run my swing portfolio. So I'm going to explain all that. As always, I'm sharing with you how I run my own portfolio. This is a virtual hedge fund desk. You're a portfolio manager on the desk. So you got to take the information, figure out your strategy, risk tolerance goals, execute it, and be the smart money. Take that responsibility. Okay, so step one. Rate cuts and the weakening dollar are driving the investment landscape right now. Last week, we all knew the Fed was going to start cutting rates. And then last week, Chairman Powell made his comments at Jackson Hole, and now it seems to be a fait accompli. It's just a question of how aggressive he is when it comes to rate cuts. I'm going to begin today by drawing attention to a comment Errors put into the Slack room, ARMR Insider Errors. I appreciate this comment Errors because I've been saying for a while now, I think there's this common misconception. When the Fed starts cutting rates, everyone thinks the market goes up. And that's not really the case. The Fed's generally behind the curve. So when they begin cutting rates, it's because things are getting real bad. And it can have a negative effect on the stock market. And first of all, let's just look at this picture real quick of what happens to employment when the Fed starts cutting rates. This is what Erez posted for us. See, when the Fed starts cutting rates, this goes all the way back to 1970 something, right? The unemployment rate skyrockets, right? Because the Fed's always behind the curve. By the time they start cutting, the numbers are already terrible. And so, of course, they're going to get terrible for a while. And so what the narrative changes to is whether or not the Fed's so far behind the curve that they don't know what to do with themselves, right? Like, how do they catch up? And then everyone starts to worry about the stock market